Hello everyone, we are from Group 5, consists of me, Nadia Alia Fitri, Alia Zakira Utami, and Yasmin Luxia. We will present about the VAT sanctions. Here is the table of contents that we will present today. There are 5 subtopics that we will explain. There are fines, interest, increment, penalties and crime, and expiration. We recognize 2 types of sanctions in the tax regulation in Indonesia. First, administrative sanction in the form of fines, interest, and increment. The second type is criminal sanctions in the form of criminal fines, confinement, and imprisonment. We will explain all of this in the next slide. So the first is fines. One of the most common administrative sanctions in the tax law is fines. The following values are imposed for administrative sanctions, such as if the periodic annual tax return is late, it will be subject to a fine of 100,000 rupiah until 500,000 rupiah per annual tax return. Next, if the annual tax return is submitted late, a fine of 100,000 until 1 million rupiah per annual tax return will be imposed. Third, taxpayers who make their own correction and have not been investigated will be subject to a fine of 150% of the amount of underpaid tax. Next, entrepreneurs who have been confirmed as taxable entrepreneurs but did not make a tax invoice or have made a tax invoice but did not arrive on time will be subject to a fine of 2% of the tax imposition basis. Next, entrepreneurs who have been confirmed as taxable entrepreneur but do not fill out a complete tax invoice will be subject to a penalty of 2% of the tax imposition basis. And the last, taxable entrepreneur who reports a tax invoice but does not comply with the tax invoice issuance period will be subject to a penalty of 2% of the tax imposition basis. Next, we're gonna talk about interest. The amount of interest will be calculated based on a certain percentage of an amount, starting from the time the interest becomes a right or obligation until it is finally paid. Based on the updated data on interest rates for the tax administration sanctions from the Decree Ministry of Finance number 60/KMK.N/2021, the following are tax sanctions rate based on the type of tax violation. As you see in this table, there are 9 types of tax sanctions. There's also tax sanction interest rate started from 0.51%, 0.63%, 1.35%, and the last is 1.76%. And also there's uplift started from 0% until 15%. Based on the updated tax return interest data from the Ministry of Finance, the following is the tax return rate based on the type of tax benefits. As you see in this second table, there are 3 types of tax sanctions. The first is refund of overpaid tax after 1 month, late issuance of overpaid tax assessment, and the third tax audit is continued with the interest rate. The interest rate is 0.51. Next is use of the tax administration sanction interest rate that will be explained by Yasmin.
Okay, I will continue Nadia's explanation. It is related to the use of tax administration sanction interest rate. There are 3 administration sanction of interest rate. First, penalty is related to annual tax return. Tax penalty interest rate, the calculation is tax penalty interest rate plus 5% divided by 12. And then there are penalties for not paying annual tax return underpayments. To calculate it, we need to calculate tax penalty interest rate plus 10% divided by 12. And fines for not paying the underpaid tax and getting tax underpayment assessment letter, we need to calculate tax penalty interest rate plus 15% divided by 12. The imposition of sanction is a maximum of 24 months or 2 years. Fines related to criminal act due to disclosure of untruth. The penalty rate for disclosing untruths or data discrepancies in the context of tax crimes, as well as attaching information whose contents are incorrect, is 100% of the amount of tax underpaid when the disclosure of tax reporting is incorrect. Termination of investigation. Acts in the field of taxation is only carried out after the taxpayer has paid off the tax that is not or underpaid or should be returned and is added with the administrative sanctions in the form of a fine of 3 times the amount of tax is not or underpaid or which should not be returned. The next slide will be explained by Valia.
Hello dear classmates and lecturer. My name is Valia Zakira Utami and I'm going to explain the part 3 and 4 of this presentation. 3. Increment. One of the administrative sanctions that is most avoided by taxpayers is the increase in administrative sanctions. This is because if the taxpayer is subject to an increase in sanctions, the amount of tax that must be paid can be doubled. The increased sanction is calculated by a certain percentage which is seen from the amount of underpaid tax. Percentage of the incremental administrative penalty. Disclosure of untruth of the SPT before the issuance of the SKP is subject to an increase of 50% from the underpaid tax. And if the SPT is not submitted as that in the warning letter, the PPN or PPNBM that shall not be compensated or not the 0% rate is not fulfilled in Articles 28 and 29, namely, A. PPH that is not or underpaid is subject to an increase of 50% from PPH that is not or underpaid. B. Not or less deducted or collected or deposit will be subject to an increase of 100% of the income tax that is not or less deducted or collected. And C. Unpaid or underpaid PPN or PPNBM is subject to an increase of 100% from the unpaid or underpaid PPN or PPNBM. And tax underpayment on SKP KBT will be subject to an increase of 100% of the total tax underpayment. 4. Penalties and crimes. Based on tax law, there are three types of criminal sanctions, including first, criminal fines, imposed on parties who commit criminal acts or of a criminal nature. Criminal sanctions are imposed on taxpayers and are also treated with tax officials or third parties who are proven to have violated applicable norms. Second, confinement. This criminal sanction is only imposed on taxpayers who commit violations, for example, the taxpayer himself or a third party. The provisions of this act are the same as those punishable by a criminal fine. However, confinement means that the party who commits the violation will be locked up. And third, imprisonment. The same as imprisonment. Imprisonment is a punishment for the privation of liberty. The same as confinement. Imprisonment is a punishment for the privation of liberty. The threat of imprisonment is not addressed to third parties, but only to officials and taxpayers.
So I will continue Valia's explanation. We will go to expiration. There are legal basis of tax invoice validity period. Provisions regarding to the validity period of tax invoice are regulated in first, Law number 42 of 2009 concerning value-added tax and sales tax of luxury goods. And then VAT Law Article 13, Paragraph 1. Article 13, Paragraph 1 VAT law applies the following provisions governing the validity period of tax invoice are: first, tax invoice must be made at the time of submission of PKP or GKP. And then, when receiving payment, invoice must be submitted at the time of payment before submission, and then at the time of receipt of the payment term. Input tax that can be credited but hasn't been credited without to tax in the same tax period can be credited in the next tax period, no later than 3 months after the end of the relevant tax period, with condition before it charged as an expense and hasn't been audited. In the tax invoice has passed the time limit for its creation but has not passed 3 months since it should have been met, the PKP of the seller or service provider may be subject to tax sanction, but the PKP of the service recipient can still be credited. The validity period of a tax invoice is called expired if its creation has exceeded a period of 3 months from the time it was met. So we'll talk about consequences of expired tax invoice validity. Even though the tax invoice must be met following the validity period of the tax invoice in Article 13, Paragraph 1 of the VAT law, in practice it often happens that the tax invoice expires, aka past the specified tax invoice validity period. The VAT law explicitly states that a tax invoice must be met at the time of submission of PKP or GKP, or at the time of receipt of payment if the payment occurs before the submission is met. If you pass this limit, the PKP may be subject to a fine of 2% of tax baseline or DPP. Making tax invoices with crediting tax invoices are two different things, although they can be related because in the end of tax invoice created by the PKP will be credited as input tax by the PKP counterpart. The time limit for making a tax invoice is for the seller's PKP, while the input tax credit is on the buyer's PKP side. So I think that's all from us. Thank you very much for your attention. Hope this PowerPoint is helpful. Thank you.